welcome to How to Go Independent. I'm your host, Sean Kernan. Here on How to Go Independent, we help you discover, learn, sort, and act on information about how to become an independent financial advisor, particularly if you're an employee advisor right now. So up until now, I spent quite a bit of time explaining why it might make sense to go independent. And I've spent a lot of my 14 years in the industry either figuring that out for myself or talking to other advisors and articulating a case for doing so. But I thought it might be time to have an episode talking about when you would not want to go independent, because it's obviously not for everybody. If it was for everybody, we wouldn't need this show. There wouldn't be 60,000 or so advisors at the 4 or 5 largest firms, actually more like 75,000 at the biggest 5 firms that are employee setups. So I want to go through a list of reasons why you definitely would not want to go independent. And I tried to organize these to some degree, and I realized it would be hard to categorize them, so it might bounce around a little bit, and I apologize for that. But hey, you get what you pay for sometimes when it comes to podcast content. So I hope you're enjoying this free content. The first reason is a very obvious one, and if you fit this one, you might not even be listening to this. But if you do not want to, you don't need to, and you like where you are, and you see no reason to change, obviously you would not want to go independent. I would love to make the argument for why that person who's comfortable, happy with their income, happy with their environment, still might want to look at exploring, to have a backup plan in place, look at the options. But to be honest, it's hard to make that case. I think someone, as I said in a blog post recently, needs to have the commitment and mindset. So I don't think that person should really explore it if they don't have even the slightest inkling of why they might want to, or they don't want to learn more. I don't think that person should be pushed, because I've come to believe in both this industry and life in general. I think you want to look for decisions that don't feel like they're forced. So basically, if you're happy where you are, you're making good money, or you're comfortable with your income, you don't see any obvious threats to it, which again, those aren't the ones that get us. It's usually the ones we don't see. But obviously that person's not ready to go independent, so they shouldn't. So number one is you don't want to, you don't need to, and you like where you are. You're really happy. So good for you. Carry on. The second reason that I noted is you should not go independent if you can't do what you think is best for your clients. So if you have the type of business that has particularly products and services that only a large bank can service or provide, like certain kinds of loan products, or if you're working with a firm that has an investment banking arm and you're used to doing IPOs or syndicate business, or any other proprietary type of investment that can't transfer or you can't use in the future. So if you have a proprietary investment that you are using on an ongoing basis that you think is the best fit for your clients, then obviously you shouldn't move, because you need to make sure that wherever you go has the capabilities to do what you think is right for your clients. And I probably don't talk enough about that aspect. It's kind of just an assumption to me that we're all trying to do what's best for our clients, and we've done our homework, have the professional competence to determine that, and have the ethics and the fundamental morality to do so. I probably don't focus enough on that on this show, but I want to make sure that's an underlying assumption that I make about any financial advisor, particularly one that will want to have their own practice and have more control and less interference in deciding what is best for their clients. But there are cases where if you've built a business that's based on business owners needing large amounts of capital, maybe one of the large banks is a better fit. That doesn't happen to be the case for me or most of the advisors I know. But, there are certainly cases where the stickiness, the relationship might be hard to undo. And that might not be good for the client if they didn't have access to their, whether that's banking products or loans, syndicate IPO stuff, proprietary funds, a particular way of processing business for some reason. I can't imagine there are too many things that fit this category, but again, Number 2 is if you can't do what you think is best for your clients, you should not go independent. And number 3 I listed was if you're looking for the biggest amount of money in your bank on day one, that you go independent. So the upfront check. I did an episode I'll link to in the show notes about, comparing going independent versus taking the check proverbially. And if you're interested in that calculation or the kind of the analysis I did, I'd go back and listen to that episode. But there's no doubt that if you're trying to maximize the dollars in your hands, that going to one of the major wirehouse firms would dwarf any money you might get in an upfront transition from an independent firm. Typically, that's going to be more, the hybrid channel, somebody with a broker dealer. I do see around 20 to 25% upfront money from the large independent broker dealers these days, as I record this in the middle of 2016. Obviously, the larger wirehouse firms are going to be 4 to 5 times that, if not more. So, again, there's a whole episode I've done analyzing that. The catch on the wirehouse upfront money is it's not your money, because if you have a 10-year deal and you sign a note forgivable loan for 100% of your trailing 12 revenue, well, then really you're only earning it at the clip of 10% per year, because it takes you 10 years to actually own that money. It's just been loaned to you. So it can be a bit of a trap if you're not careful. I did do one of those deals back in 2005 with Morgan Stanley. It worked out well for me, as you can listen in episode 1. I think I knew what I was getting into. I knew the risks. I even ended up paying him back for the 5th year because it just was worth it to me to start on my independent journey. But bottom line is, the third reason you wouldn't go independent is if you're looking for the most amount of money today. For whatever reason, it's just not the way to do it. Number 4, you aren't willing to work hard for a short period of time to improve your business and have more control over it. I have a good friend who, after 14 years in the industry, all at one firm, and I met him as we started in the firm about 2 months apart, 14 years ago. He is in the process of moving his practice right now from the only firm he's ever been with. It's a pretty significant business. He's been very, very successful in that 14 years. So he's got a lot bigger business than I had to move when I moved after 3 years and 7 years in the business. So, the reason he's willing to do that is because he sees the crush of activity and work, and then he'll have more control over his practice, and, he has ownership, all the benefits that I talk about on the show and on the blog. But there is a big caveat to that. It is a lot of work up front to invest in your business. Moving that many accounts is obviously a lot of work. We're busy if we have 5 new clients at a given time, or 10 new clients, depending on the size of your staff. But think about having 100 new clients, or 200 or 300 new clients, because that's what you're doing when you change firms. You go from having, let's say, 200 to having 0, and then trying to add 150 at one time. It's a big undertaking. Now, again, there's a blog post series I did about the things I think you need to have. I believe I did a podcast episode on that as well, on what I think you should have and need to have to pull the trigger, the absolute must-haves. And one of those is help. Figure out how you're going to get all that work done. Are you going to hire someone full-time? Are you going to bring your existing assistant? Are you going to find a network to plug in that has resources you can use? There's actually outsourced solutions where you can hire an assistant remotely, kind of on-demand need. So there's all kinds of ways to accomplish that, but bottom line, it's going to be a lot of work for you as well. So number 4, if you aren't willing to work hard for a short amount of time, or harder than you have in a while probably, to get more control of your business, you're not ready and should not go independent. Number 5, why not to go independent? Pretty big one. If you don't think your clients will go with you, then you should not be independent, because all the economic benefits, the flexibility, the control, if you don't have clients, or as many as you think you need to, it's pointless. So times when that might be an issue. If you recently inherited a lot of accounts or clients, relationships, you don't have a lot of depth in those relationships, and they've been with your firm longer than than you or longer than your relationship with them, there's a good chance they're not going to come with you. So I'd recommend in that case sticking around, getting to know your clients, making those relationships with you. The longer, the better. There's always going to be a point where you have to pull the trigger if you're going to do it. But in general, if you've inherited relationships, they're not your quote unquote your clients. When we do the analysis of who we see be successful in transition, advisors that work at commercial banks, retail banks, not the wirehouses owned by banks, but the Chases of the world, Bank of America, the Wells Fargo bank program, those advisors tend to have lower retention than, say, a wirehouse or large regional firm person who's been at the same place a long time. My friend who's been at the same firm for 14 years, I expect he'll have very high retention. I actually am recording a interview series with him. I've already done 2 episodes, 2 different parts of that. One was about 2 weeks before he moved, and one was about 2 days before he moved. So I will be interviewing him several more times to kind of you can hear the progression of that, at some future time when his non-compete is over, etc. But my point is he's going to have a high retention because he was at one firm for 14 years, developed very deep relationships, did a good job for people. And that's kind of, one firm with satisfied clients. That's a pretty easy thing to predict that he'll have high retention. But if you've been at the same firm and you took over, let's say someone inherits his office, which they are, and 2 years from now they try to leave, they're not going to take much because those clients that stay behind with the original person leaving, they are definitely more attached to the firm now than the individual advisor. No doubt about it. Or if you're at a bank, or if you're an employee and you think all the people who you help work with, you service their relationship, you're the point person, but there's a much bigger organization behind you, especially if there's a founder that has worked with them, you're probably not going to be able to take as many relationships as you think. So just be very careful about that. Again, I think there's a lot of resources out there, but I'm happy to answer questions if people have a specific situation they'd like to discuss. So that was number 5. If your clients won't come with you, do not go independent. Number 6, do not go independent if you have contractual obligations that will be detrimental to your long-term business if you leave. For example, if there's a very strict non-compete or non-solicitation agreement that is going to expire within a few months, I would recommend waiting that out. Unless for some reason you have insight that a lot of advisors have left and it hasn't been enforced. But again, it could always be enforced. Firms are always able to decide to do more than they've done in the past if you violate some part of their contract. So if there are certain obligations that are really going to hurt your long-term business if you leave, then I'd say, wait those out or try to figure out, make sure you've got a very thorough plan to account for those. Number 7, if you would rather trade a huge chunk, or what I would call a huge chunk of your revenue, to have complete simplicity and not have to do anything from an administrative standpoint about your business in terms of running the business, then maybe you shouldn't go independent. What I mean by this is I see as we run our network that we offer very much an a la carte arrangement. So if someone wants office space, or if we have an assistant that has capacity that they're going to share, or if they're going to go in on office supplies, all that is just divvied up on a pro rata basis. We have a slight markup maybe on the office space, but it's market based, and more importantly, it's a la carte, meaning if you use us for the compliance and overall relationship, then if you pay rent, you pay that separately. You pay, if you have an assistant, you pay that separately. It's very a la carte, and that may, for some people, that might sound complicated. It's really not that hard to set up. We're willing to help. Lots of people have done it before, but again, I will acknowledge there's more to it than being at Morgan Stanley. Whether your office, you're told where to office, you're told what you can do, you're told when to go to the bathroom, whatever the variables are. So if you're willing, now, a lot of independent firms, including ours, can package all those things to replicate the wirehouse environment from a simplicity standpoint. So if you want us to do everything for you, sure, we'll do it. We'll make your coffee every morning. We'll get your Wall Street Journal, put it on your desk, but we're going to charge you for it. And now, luckily, we're going to charge you a lot less than the wirehouse. But my point here is, if you'd rather have just this absolute simplicity at the wirehouse, where you don't have to think about really much at all except your clients, then as long as you're willing to acknowledge that's a costly decision, then I'd say carry on. Don't go independent, because there is more work. So you're definitely going to have to figure a few things out on your own, or at least make decisions. You can always find someone to outsource to or hire on a project basis to set up an office, set up technology, integrate technology, research different tools you can use, or there's a lot of different micro decisions that you might have to make if you're independent that you do not have to make as an employee advisor. Now, I would argue, again, I'm a little bit biased, I would argue it's great to have all those decisions to make, even if you don't really think about them. If you're looking at your CRM and you like what your old firm has or what your firm right now has, there's no reason you need to scour through 100 different CRMs. You could talk to someone fairly knowledgeable and say, hey, here are the 3 or 4 things I really need this to do for me. What do you recommend and why? So, I would be happy to field that question from a CRM or other tools basis. So, number 7, if you're willing to trade, a big chunk of the profitability of your practice in exchange for more simplicity, you probably shouldn't go independent, because the wirehouses do make it easy on you and keep it relatively simple on the things you have to worry about. The 8th reason you shouldn't go independent, there are some life changes where it would make sense to wait. I'm always leery of people having arbitrary things that are their roadblocks, whether that's beginning of school, end of school, Christmas, Thanksgiving, graduation, funeral, you name it. But there are some life changes that it might make sense to work around. One that came up as I was thinking through valuations for firms was if you're about to go through a divorce, you may want to, for strategic financial purposes, not go independent, because your value where you are probably doesn't have much true value. And hopefully, if for your side, your benefit in the negotiations, hopefully your spouse doesn't try to claim that you own a business, because you can successfully argue you don't. You have no right to it if you're at Merrill Lynch or Edward Jones or Wells Fargo or wherever, UBS. So you can use that to your advantage. If you now have your own practice, it's pretty hard to argue that. So if you have a decent sized business, especially if it's a large asset for you financially, you might consider delaying that, so that even if they do attach a valuation, it's going to be lower, because the economics are not as good when you're working for someone else and you're deducting all those things that might be deducted from the paycheck. So if you're about to go through a divorce and you think it might not be pretty, there might be a benefit to waiting from a financial standpoint. Another example might be if you're having a baby, either you or your spouse or your significant other's about to have a baby, and you might want to delay that change, just because that can be a lot to deal with at once. In some way, you're giving birth to a new business and you're having to move all your clients, so you've got a lot to do, and it can be done if there's a need. I wouldn't say that should stop someone from going independent, but it's certainly not ideal. I think ideally you'd give the birth of a child as much focus as you can, both for the child, the mother, and the whole family. And starting a new business is a big deal. When I did it, my daughter, who's now 9, was 2.5, and she was our only one at the time. My son was born later. So, and they actually were out of town when I pulled the trigger that first week or so. We had visited my in-laws during that time frame, and I came home a week before they did, to pull the plug and get going and get everything moving. And that was nice to have that focus for that week or so, that I didn't have to juggle family and business responsibilities. So there are probably some other life situations, probably not as many as you think, because again, if you find the right help, you'll be able to leverage other people's expertise and experience, and that should speed up the transition, get you back in business a lot faster than if you try to do everything yourself. Number 9, you should not go independent if the only reason you're doing it is to make more money. So I know that's a bit of a paradox, because the financial benefits, from my perspective, are very obvious for 80 to 90% of advisors and how they end up running their practice as independent advisors. But that should not be the primary or the only driver, and certainly shouldn't account for, the vast majority of the reason to do it. And that's because, like most businesses, if you're not really doing it for the right reasons, it can tend to be a short-term benefit. You need to be wanting to serve your clients better, have more flexibility, less sort of bureaucracy, all kinds of reasons. And that should include money, probably. It's more profitable, and you can also probably do more for your clients because you've cut out the third-party overhead or cut it way down. So a lot of that you can allocate back to clients, especially as time goes on. But in terms of if you want to charge lower fees, there's more room in the relationship. If you're charging, say, 1.5% a year, so you're only keeping maybe 60 basis points of that. Whereas if you go independent, you lower your fee to 125 basis points. Well, now you're probably keeping 100 of those basis points. So the client pays less, you still get a lot more and out of your business. Now you have expenses, but at the margin, you have more flexibility to be flexible if you want to. So, but I think the main point is making more money shouldn't be the primary driver. If you're just about short-term dollars, again, go back to the point about taking the upfront check is just going to be a more efficient way to do that. But you should make more money. I'll make that clear. I certainly have, both because I've grown a new business in the network we've built, and I've run a very streamlined, efficient operation in terms of how I spend or don't spend money on my practice, and I've grown the gross revenue of the practice. So sort of a three-headed monster there, three-pronged approach to higher income for me has been a whole new business. Is not everyone's going to do that. But then the other is growing the gross revenue. Again, the market's been on an upward trend since I went independent, so that hasn't, a lot of us have had that rising tide, but also a much higher net payout because of the economics of the independent practice. So there's no doubt it's more profitable, at least for most of us. And I can, again, I'm happy to talk to anyone who'd like to discuss, the numbers. And if they don't see that, I'd love to see what kind of assumptions they're using. But bottom line, number 9, reason not to go independent is just to make more money. And number 10, which at the moment is the last one I have on my list, is if you have significant amounts of compensation that you cannot get out of your old firm, and you've done the math and decided it's just not worth the risk, then I think that's a legitimate reason to stay put. So if you have deferred compensation, you have a retention bonus, either from the mergers that happened back in 08, 09, or just transition money. If you have a traditional pension that, is going to see a benefit if you stay, the back end of your career, those, a traditional pension really pays off with the way they calculate the numbers. Or if you've had accounts handed to you, if you're in a large wirehouse, you've got good relationships with the managers, or for whatever reason you have accounts being handed to you that you develop into good relationships, that's a form of compensation that you're probably not going to see if you move somewhere else. So I think that's something to consider. Again, a lot of this is, what does the math look like? You could have several $100,000s or more in deferred compensation types of accounts and still make the case that going independent might make sense because of the long-term equity value you're going to build and the elevated payout compared to where you are. So there's all kinds of reasons to do that math. But I'm a little bit surprised how few people really do the math. They just say, well, I can't give up this $150,000 without saying, well, what would I get and how long would that take to break even? Doing a real cold-hearted or cold-blooded analysis versus just the I don't want to lose something and stopping it there. I think that's ironically that appears to be what these big firms do to get fewer people to consider a change, which is natural, but seems to me if we're in the business of giving people financial advice, we should use a little bit of logic, or at least try to, when making these kinds of decisions. And again, the pension is an interesting thing. At Morgan Stanley, I think it went away in 2007, but I had gotten there in 2005, so I was covered under the old rules with a traditional pension. And, I did that math and tried to figure out how to value that, the income stream at age 65 as a series of discounted cash flows. What is that worth? And it was a nice asset, but it also meant I have to stay there at the time another 31 years, and that just didn't seem very smart to make that kind of calculation or gamble that it would first of all, they'd have the pension that long, and also that I would benefit from the numbers that were being projected. Well, that's the main topic for today. That's really all I have. Those 10 reasons why you would not want to go independent. That's all for today, and we will see you next time.